Hello there, welcome to my channel. In this video, we are continuing a discussion on financial modeling and valuation analysis, and we are specifically looking at Amazon.com as a case study. So in my previous video, we looked at the introduction, we extracted the Amazon financial statement into Excel, we also looked at our income statement. In general, we looked at some of the subtotals that we need as a form of normalizing our income statement for financial modeling purposes. So we are going to take our discussion further by looking at how to calculate historical ratios and drivers, and also make projections of some of the line items in our income statement. So that is what we are coming to do in this particular video. Now, before we do that, we want to do a bit of formatting here. So we are actually going to look at the performance of Amazon.com over the next 5 years. So we have a 3-year period of historical financial statements. We're going to project the future performance of Amazon.com using or based on these 3 historical financial statements. So let's do a bit of formatting here. So selecting my year row, I'm going to my font color here, and then I'm going to pick okay, sorry, this is not supposed to be font color, so I'm going to come to fill color, and I'm going to pick this particular green color here, and also change my font color to white. All right, now having that, I'm going to have this. So I have my historical 2023, which is the last historical year, and then I'm going to add 1 to that. So that will give me 2024. So you are projecting from 2024 through to 2028. So using Control R, this is going to give me that. All right, and then I can also bolden that using Control B. All right, so that is what we are having there as reformatting. So in this particular video, our focus is going to be calculating historical ratios based on our historical figures that we are seeing here, and make future projections based on those ratios and other information that we may be obtaining going forward. All right, so that is that. Now let's start with revenue. Now, from our last video, we understood that Amazon actually generates sales through 2 main sources, okay, from their products and then from their services. All right, so that is their 2 revenue generating sources. So looking at this, we can decide to project the sales individually, as you have seen here, or we can just look at the total net sales and project that alone. But because we are calculating our historical financial ratios, let us calculate the year-over-year growth rate for each of these items and see how our sales have been performing year over year. All right, so that is what we are going to do. So for net sales, I'm going to have year over year. So my year over year is going to be y/y growth rate. I'm going to do same for this y over year, y growth rate. Then I'll also have y over y net sales. Now remember, sales is also called revenue, so don't be confused. Whenever you hear about sales, we are also talking about revenue, so they are used interchangeably. All right, so these items, we can italize them using Control I, and also shift them a bit. So do that formatting, shift these a bit. So remember that I actually left the pro forma or the template for this particular financial model in my first video, or I'm going to leave it in my video description. But for you to continue, you might have to watch my previous video where we started off, so that you can be able to follow through. So if you haven't watched my first video on the introduction, then please kindly go back and do so. And also, if you have not subscribed to the channel, please subscribe to the channel so that you can all the new videos that I'll be releasing on this particular series. All right, so that is what we have there. So let's calculate our year-over-year growth rate. Now, when it comes to revenue, we cannot calculate the year-over-year revenue for the first year, which is 2021 historical financial statements. Now, we have these years here, and we don't know which ones are actuals or historical and which ones are estimates or projections. So to be able to do that, we can insert some distinction here. So I'm going to select my 3 historical years from 2021 to 2023 and hit Control 1. When you hit Control 1, it's going to bring Format Cells dialog box here, and then you come to Custom here, select the 0 here, and then in the Type menu here, I'm going to bring quote, that is the double quote, add A, and close my quote and hit OK. Then this is going to add A to my historical data here for me. And so this is telling me that these are actuals figures. Okay, these are actuals. And then I'm going to do same for my my estimates years as well. So hitting Control 1, I'm going to custom 0 here, open quote, hit E, which is estimate, and then I'll close my quote and hit OK. And that is also going to insert E here for me. All right, so that is what we have here. And then also I can also change the fill color here. So coming to selecting the 3 historical financial years again, I'm coming to my phone section here, fill color, and I can pick so let me just pick this red color here. All right, so that differentiates it from my estimated years, okay, or my estimate years. All right, so as I said, when it comes to calculating a year-over-year growth rate, we do not start from the first year because we don't have a previous year for the first year. So we always start from the second year. So to be able to calculate the year-over-year growth, the formula is equals the current year under which we are working divided by the previous year minus 1. That gives us the year-over-year growth rate. And we have to change this to percentage. So change that to percentage, and then also increase my decimals to 1. And also I can come here and do same equals this, the current year divided by the previous year minus 1, and also format that as a percentage with 1 decimal place. And then I can do that for my total net sales as well. So this divided by this minus 1, change it to this, and also increase the decimal to 1. So all right, so with that I can actually copy the formula to the right using Control R. Also copy this to the right using Control R. Copy this one to also to the right using Control R. All right, so those are our year-over-year growth rate for our net sales. All right, so that is the historical growth rates that we have seen there. Now let's continue to our operating expenses. Now the first operating expenses we are going to look at is our cost of sales. So let's first of all insert a line here. As I said we should insert certain lines there. Now, cost of sales is usually calculated as a percentage of the total net sales. All right, so that is what we do for cost of sales. So for this one, we are not going to calculate year-over-year growth. We are going to calculate the cost of sales as a percentage of sales, because as we will look at going forward, cost of sales is actually a direct cost, and so it is directly related to our sales. So we are going to look at that later. But for now, let's calculate the cost of sales as a percentage. So we have COS, which is cost of sales, as a percentage of net sales. All right, so I'm going to italize that and also increase the indent to the right. All right, so this is going to be equal to our total, this is going to be equal to our cost of sales divided by our total net sales. All right, so that is giving me 1 there. And the font color has to be black because it's a formula. And also change it to percentage and increase the decimal place to 1. And I can copy this to the right using Control R. Okay, so that is our cost of sales. Then we come to gross profit. Now, gross profit is also going to be calculated using what we call gross margin. Now, the gross margin, all right. So the gross margin is also calculated in a similar way as a percentage of our total sales. So let me increase the indent and calculate that. So it's going to be our gross profit divided by our total net sales. All right, so I can have that. Change this to percentage, increase it by 1 decimal place, and copy the formula to the right using Control R. So that is what we have there for our gross profit. Now let's continue with the rest of our operating expenses. So we have fulfillment costs. Now it must be noted that all of our operating expenses are going to be calculated in a similar way as our cost of sales figure here. So this is what we are going to do. This is going to be equal to this figure divided by my net sales. And then enter and then increase, change the percentage, increase by 1 decimal place. I'll use it for this equals this divided by our total net sales. Increase this by, change the percentage, increase by 1 decimal place. So I'm going to do it for all the other operating expenses divided by this. Change the percentage and increase the percentage by 1. And finally, I'm going to do it for other operating expenses for income. So that's going to be equal to this. And so that's equal to this divided by our total net sales. And also increase this 1 decimal place. Alright, so now I'm going to this for them, copy the right, using Control R, copy the right, using Control R, copy the right, using Control R, using Control R, select the area, using Control R, copy the right. Now let's increase these switches here. So I'm going to have fulfillment. So that's going to be fulfillment cost as a percentage of net sales. And what I'm going to do is to select all the areas here. So holding Control, I'm going to select this, select here, select here, select here, and I'm going to italize everything here and also increase the indent 1. Right, so I've done the following. I'm going to copy this, this here, this here, this here. So you can see time by these checks. So instead of fulfillment, I can say technology and infrastructure. So yes, shorten that. Come here. It will be sales, and marketing as a percentage. This is going to be general and admin, and then this is expenses. Operating expenses as a percentage. So this is off. This is off. Alright, so now that I've done all of these, we can continue to our operating income here. So we have our total expenses, and then we can leave that, and then we come to operating income, or which is EBITDA. So for EBITDA, we are going to have EBITDA margin. Now these margins are going to prove useful going forward. So just relax. So EBITDA as so we have EBITDA margin. All right, so I'm going to do the same formatting, italize this, and also increase the indents. Right. So I have this. All right, so let's calculate our EBITDA margin. That is going to be our EBITDA, or the operating income, divided by our total net sales. All right, so that is what we have there. So we can change that to percentage with 1 decimal place and also copy it to the right using Control R. So that is our EBITDA margin. For depreciation and amortization, we are going to use what we call the supporting schedule, depreciation schedule, or the PPE schedule to be able to forecast this. So we don't need to calculate any historical ratio for depreciation and amortization. So let's continue to EBIT. We are going to have EBIT margin as well. So EBIT margin, and you have italize this and also increase the indent there. So as usual, this is going to be our EBIT divided by total net sales. Change it to percentage with 1 decimal place and copy this to the right using Control R. All right, so we have those. And for interest income, interest expense, these are also going to be projected using our debt schedule, which is also part of our supporting schedules. All right, so as you can see, we have PPA schedule here, we have working capital schedule, as well as the debt schedule. So we are going to build all of these in our subsequent videos. So that is where within the debt schedule is where you are going to forecast these two items. So we don't need to calculate any historical ratios for these. And then we'll come to other income. For these, they are also very difficult to determine their composition. And so we do not calculate any historical data or ratios for this particular item, line item. We are going to deal with how we are going to project it later on. And then with that, we will have our total operating income expense there. And then also our income or loss before income taxes, or EBT. So we are going to also calculate our EBT margin. So let's italize this and also increase the indent. So this is going to be equal to, as usual, when you hear about margin, we are talking about percentage of revenue. So this is going to be our EBT, earnings before tax, divided by our total net sales. So I'm going to input that and convert that into percentage with 1 decimal place. Copy this to the right using Control R. Alright, so now that we have gotten that, let's also calculate what we call effective tax rate. Okay, so that's going to be our effective tax rate. So italize that, increase the indent. So our effective tax rate is going to be equal to our tax or tax expense, all right, divided by the income or earnings before tax, which is this. So I'm going to do that, and I'm going to convert it to percentage and increase it to 1 decimal place, and also copy the formula to the right using Control R. Now, all right, so that is what we have there. Then we have our net income, our first net income here. Then we deduct or add equity investment activity. Now, this equity method investment activity here, as I explained before, is investment in associates. Okay, income or loss from investment in associates. So that is what we have here. An associate is simply another business in which the company we are considering, which is Amazon.com, has interest in. So such an interest doesn't give control, but it gives a certain form of influence over of Amazon over such companies. So these amounts or these income or expenses are what we have incurred from our investment in those associates. All right, so that is what you are having as the equity method investment here. And we are going to project, it's difficult to project how much you are going to make, or even if the company is going to make any incomes at all. So we are going to leave them as they are. All right, and then with that we can have our net income or loss as reported. All right, so That is what we are having there. Now, this net income as reported, as we have already said, is equal to the first net income here plus our equity method investment activity. So that is what we have there. And that is giving us this. All right. Now that we have gotten everything here, let's also take note of our other information here, which is our EPS calculations. So as for these, we are going to use the other figures to be able to do this. So we have come to the end of calculating our historical ratios. So now let's go to projections. How do we make our projections? Now, for our purpose, we are going to leave the categorizations of the sources of our sales blank. All right. So in order to do that, I'm going to just select the area here, and to show that I have intentionally left this place blank, I'm going to paint it with a faint white here, like that. All right, so that is fine. This shows that I have intentionally left this particular space blank. All right, so I'm just going to consider our total net sales. Now, this is a matter of choice. All right, you can decide to project the individual sources of revenue. You can try your hands on that. You can do that as well. It is not wrong. So this particular video, I am going to consider only the total net sales. All right. Now, making projections, okay, requires an extensive understanding and research of the core business model of the company in question, how it generates its revenue. We have to understand the cost structure and beyond to best get a handle on the future performance of any business before we can make projections. All right. However, there are accepted methods of making projections which are considered good enough to use as a tool to perform a company valuation. So it must be noted that a world-class financial model is one that is flexible and functional, and that is easily adjusted to reflect new and developing information over time. So what that means is that all the projections we are going to make in this particular video or now are going to be based on general assumptions, and that is fine, because as a good financial modeler, we always make projections based on simplified available information, and then later we can tweak these assumptions to be able to reflect the reality on the grounds. So we are going to stick with some simplified assumptions to develop our model, and then later we can do a lot of digging and also research of the background of the core operations of the business, which is Amazon.com, to be able to tweak these assumptions to reflect the reality. So that is what we are going to do. Now, when it comes to projecting revenue, it can be quite tedious. It is therefore important to research and understand the company's business model, gathering as much information as possible to make a sensible estimate. Revenue is almost always driven by price and volume. All right, so we're talking about price and volume. And a typical research should be based on these variables, the price and the volume. All right. So we need to ask certain questions when we are projecting revenue. For instance, what initiatives is the business taking to increase its volume in 2024, for instance, or 2025, for instance? All right. Is it increasing advertisements in order to increase its sales volume? Or is it getting more customers? Is it finding a way to get more customers going forward into the future? What external factors could impact on a company's pricing model? Is the company increasing its prices, or is it facing serious competition and therefore must lower its prices? These are some of the questions you need to ask when you are making a research about how to project a company's net sales or a revenue into the future. All right. And as you can already see, to ask these these varied questions around price and volume, we need to make an extensive research, and we do not have that time. All right, so what we do is that in addition to the research, we recommend that the following sources can be used to obtain some relevant estimates of your revenue. So the first one is investor presentations. Now, these are typically designed to explain recent and future performance to existing or future investors of the company's shares. They can contain high-level projections. This can therefore be found on investor relations sections on the company's website. All right, so that is that for investor presentations, which is a source of getting information that can help you to project a company's revenue. Now, the second one is Wall Street analysis or Wall Street and analyst equity research reports. All right. Now, these reports are typically developed by people who have studied this or followed this particular company for a very long time, and so can reliably making certain estimates about the company. All right. So Wall Street analysts are actually people who have followed these companies for a long time, and so can reliably estimate its future performance. Now, the third one, which is the one we are going to use in our scenario, is the use of data sources such as Yahoo Finance, Google Finance, and Bloomberg. Now, some of these are free and some are also paid. Okay, and these contain information that have been developed by consensus of Wall Street analysts. All right, so they usually do that. Now we are going to use Yahoo Finance for our purpose to be able to derive some knowledge about the projection of Amazon into the future. So why Yahoo Finance? Because it is a free resource, and so we can use it for our case study. So let's go to our browser here, and what I want you to do is to type Yahoo dot I want you to type finance.yahoo.com. All right, and hit enter. Now, always remember that before we continue, always remember that getting data from different sources can make your model more reliable and hence recommended. But taking just one source at a time to complete your model is crucial for time saving. Adjustments can be made after the model is completed so that we can be able to get a more reliable model. So for a start, we are going to do this information. All right, so after you have come here, after opening finance.yahoo.com, come to the right side of the page here and see locate quote lookup. All right, as you can see, quote lookup there, and this is where you are going to type the ticker symbol of the company. So for Amazon, it's going to be AMZN. So, all right, so after typing this, you can hit enter. All right, so this is going to open this particular page for us. Then you come to the left hand side here, the list at the left hand side here, and select analysis. So select analysis from the left hand side there, and that is going to open some research analysis that have been made by Wall Street analysts. So as you can see, this is research analysis, earnings per share, revenue versus earnings. We have earnings estimates, we have revenue estimates. All right, so that is the second table here. So when you come to the second table, you see revenue estimates. Now we have sales growth year/estimate. All right, so all of these figures you are seeing here are actually estimates that have been or that have developed or that have been accepted by Wall Street analysts, investment analysts. All right. So we are going to take a look at those. So for December 2024, which is the current quarter, we've been told that the estimate for our sales was 10.18%. For the next quarter, which is 2025, is estimated to be 10.69%. For the so that is the estimate we are having here. Okay. And then for 2025 as a whole, it is 10.81. So that is how we can have an idea of the projection of revenue for a particular publicly listed company. So let's come back to our model here. So with that, this is the historical ratio here. All right. So we have actually gotten a consensus estimates by Wall Street analysts. So what do? We are going to input those estimates here. So we've been told that it's estimated that this company is going to grow sales by 10.81% into the year 2025. But we are going to input that into 2024 as well. That is what we are having here. All right, so this is for 20. Sorry, this is true for 2025. So let me cut this and paste here. And then for 2024, it is 10.18. So I can come here and input 10.18 here. All right. Now I can format this as a percentage. So we have 10.18%. Increase this to 2 decimal places. And this is also 10.81. 10.81%, increase this. All right. And then because we do not know the others, we are going to assume that this 10.81 is going to continue for the rest of the years. So we have 10.81 there. All right. So that is how we forecast our revenue, our total revenue for the upcoming years. I hope you get it. So how do we then calculate our estimates revenue? So to project our revenue is going to be equal to the previous year's 2020 or previous year 2023 revenue multiplied by, I'll open my bracket, 1 plus the percentage growth rate, close my parentheses and hit enter. So that is my revenue for 2024. I'm going to format this with 0 decimal places and copy this to the right using Control R. So this is giving me that because of there's not enough space. Also increase this. All right. So that is our revenue estimate. So we are estimating that revenue is going to grow up to this point going forward up to 2028. All right. So that is what we have there. Now I'm going to italize this. All right. So that is what we have for our revenue. All right. So that is how we estimate our revenue. Now let's come to cost of sales. Now, before we do that, let us actually format all of these as that. So this is a percentage with 1 decimal place. This is also a percentage with 1 decimal place, and also realize that. I'm going to do that for all of the items. So holding Control, I can select everything and also italize this. All right, so that is fine. All right, so let's come to our cost of sales, or what others might call cost of goods sold. All right, or COGS, COGS. All right, now estimating cost of performance can be as tedious as we have seen with revenue, but revenue has been made simple for us because of the availability of information we have online. But um, unlike revenue, for cost, we do not have such an information. Now, first, it is important for us to make a distinction between fixed costs and variable costs. So we have fixed costs and variable costs. So a fixed cost is relatively static and may only change of time. Okay, so for instance, rent. Okay, so you for the first 6 months, 3 or 6 months, your rent may be static, or for even a year, your rent is going to be what? Static. It is only going to change after a specified period of time. All right, so that is what we mean by fixed costs. Now, rent is a typical example of a fixed cost. Then we also have variable cost. Now, variable cost changes directly in proportion to revenue or growth. So that is variable cost. In other words, if revenue is increasing by 10%, then variable cost will also increase by 10%, all other things being equal. Okay, now cost of sales, which is our first operating expense here, is a variable cost item because it changes with or in proportion with our sales. So the more our sales figures are changing, the more our cost of sales will also be changing. So it is a variable cost. Hence, we link it directly with revenue. That is why we calculated it as a percentage of net sales, as you can see here historically. All right, so I can delete this. All right, so that is that. So when it comes to cost of sales, assuming your revenue is declining, you are most likely selling less products. So your costs should be declining as well. And the opposite is true when your revenue is increasing. As your revenue increases, because cost of sales is directly proportional to your level of sales growth, when sales is increasing, automatically cost of sales is expected to be increasing as well. All right, so that is that. Now, this assumption is not without exceptions. All right, so revenue increase can be explained by higher prices and not necessarily increasing your volume of sales. All right, again, understanding the business model, cost structure, and its cost structure plays a critical role when it comes to estimating your cost of sales and other operating expenses. Okay, so we can rely on historical trends to make initial projections with the knowledge that we can later tweak these as we build a more fundamental understanding of the business. All right, so that is what we are going to do. Now let us look at how we can be able to forecast these expenses. All right, starting with cost of sales. Now there are several acceptable methods to do this. All right, now the first one is to take an average of our historical ratios. That's the first method. So for each of these methods, it is always advisable to try all of them and see which one of them best illustrates what is happening. All right, so you can use your historical, the average of your historical ratios. This is the importance of calculating our historical ratios. All right, so that is that. Then that's the first method. The second approach is to take a maximum or the maximum ratio among the three historical ratios. And that is what we call the conservative approach. And that is found by using the max function in Excel. So you can use equals max, which is returning the highest value in a set of numbers. All right, so that is what we can use to do that. Now, as you may rightly guess, the third method is to take the minimum percentage, which we can also use Excel's mean function, MIN, mean function, to return the smallest number in a set of values. All right, so that is what you can use. The average one can be estimated using the average function. All right, you can use the average function to do that. All right, so that is what we are having there. Then the fourth method is to take the largest or the last year's percentage. Sorry. So you can take the last year's percentage and assume that, okay, the last year percentage or the last year performance represents the most recent performance of the business. And so we are projecting that for the next 5 years, the business is going to, or it's likely that the business is going to continue in this trajectory. All right, so we can use the last year percentage. Then we also have a fifth method known as taking the percentage or to have the percentages steadily increase or decrease year over year, also known as the year over year growth method. All right, so that is what we have here. Now, when you look at our cost of sales, the figures are closely related from 58 to 56.2 to 53. Now, these have been decreasing over the period. All right, this has been decreasing over the period. And so, we can take the last year percentage and assume that this downward trajectory is going to continue. All right, we can also use the average method, which will also work in this case because the values are revolving around 50, between 50 and 53 to 58, which is not widely apart. Where you have an outlier, a figure which is an outlier, then this particular percentage or this particular method, which is the average method, is not recommended. But for this method, we can use the average method as well. Now, the one that we do not actually recommend is the minimum method, which is the aggressive approach. All right, it is more aggressive, and so we do not usually recommend that. But based on the scenario you are considering, you can always use any of these methods, especially the ones that you feel best projects your financial statement for you. So for this purpose, you are going to use the average, all right, since the figures are closely related. So I'm going to have equals average. And I'm going to pick the 3 percentages here, close my parentheses, and hit enter. So that is giving me 55.7. I can copy this across using Control R. Okay, so I don't want them to change as they're changing here. So what I will do is to anchor my here. So I'm going to have F4, hit F4 for this. Also come to the second selection here and also hit F4. So that is going to lock my figure for me, and then I can continue this using Control R. All right, so that is going to have that static for me. So now that we have our percentages here, our historical percentages, let's come here and do the projection. So to project our cost of sales, it is going to be equal to, remember, cost of sales is a percentage of revenue. So it means that for 2024, the cost of sales is going to be equal to a percentage of our total net sales. So let's have that. This multiplied by our cost of sales as a percentage of net sales. So I'll enter that. reduce the decimal places to 0, and then I can copy this to the right using Control R. So that is going to give us that. Now with this, we can calculate our gross profit. Now gross profit is equal to revenue minus our cost of sales. Alright, so I can copy the formula to the right using Control R right there, and also copy this particular format, this particular formula, which is our gross margin, also to the right using Control R. So that is what we have here. Alright, so that is that for our cost of sales as well as the gross profit and the gross margin. Now you could observe that once I scroll down, our numbers or our years at the top here are disappearing. So in order to prevent that, I'm going to first of all, let me insert a line here. I'm going to freeze the panes so that when I'm scrolling down, I'll be able to see the year under which we are working. So clicking on the first cell here, I'll go to my View tab, and then on the Windows section here, I'll click on Freeze Panes, the drop down there, Freeze Panes, and that is it. So when I'm scrolling down, I'll be able to see this. Alright, so that is just by the way. Let me actually do this. Clicking the net product sales here, I'm going to do that. So I'm going to unfreeze the panes and refreeze the panes. So freeze panes, and that is it. Alright, so this is better. Alright, so let's continue with the rest of our operating expenses. Now the same approach can be repeated for each of these items on the income statement. Conducting adequate research, analyzing historical trends, and considering whether cost is fixed or variable in order to determine which of the 5 methods should be used to project the cost into the future. These are what we do in reality, but as a start, we can make simplified assumptions. Alright, so I'm just buttressing what I said earlier. So first, let's look at the fulfillment cost trend, and then we can be able to make certain assumptions out of there. So for the fulfillment cost as a percentage of sales, we can see that these are actually ranging from 16% in 2021, increased marginally to 16.4%, and then marginally downwards to 15.8%. Alright, so this has been up and down like that. So using the methods that we have identified earlier, using the average method, the maximum percentage, the minimum percentage, and repeat the cycle, or we can also use the year-over-year growth rate method. We can take any of these methods to be able to estimate our expenses. Now, once again, for fulfillment costs, we can be able to project it using, we want to be conservative enough, so we can use the maximum percentage. All right. So we can use the maximum percentage as a start. All right. So we can have equals max. All right. So when you input max, this is going to allow us to input our figures. So we have first one. That's the first number there. So I'll bring comma, select the second number, comma, and the third one. Close my parentheses and hit enter. And that's going to return the maximum for me. I can copy this to the right using Control R. And then with this, I can also estimate my fulfillment expenses. So that's going to be equal to a percentage of our sales. So I have this multiplied by the percentage here. and that is giving me that. And this looks quite huge. All right, this looks quite huge, which means that the maximum percentage we have taken is actually not the most appropriate. So let's change it to the minimum, although the minimum is an aggressive approach, but let's see what that is going to reflect. So minimum there, and then I can hit enter, and this gives a bit more realistic value. Let's also try average and see what we have there. So I have my average, and I can hit enter there. All right, so I think the minimum is okay. So let's repeat our minimum value there. All right, I can copy this to the right. So the minimum percentage, reduce this to 0 decimal places, and also copy the formula to the right using Control R. So that is our fulfillment cost. Technology and infrastructure, for this is also going to be equal to, let's pick the minimum once again. So min, pick this, comma, comma, this, comma, and that, and close my parentheses and hit enter. I can copy this to the right using Control R, and then can have my formula there. The total net sales multiplied by our percentage, like that, and this should be 0 decimal places, and copy this to the right using Control R. When it comes to sales and marketing expenses, we can use the average in this particular case. So let's look at average of these three, hit enter. So that is 7.6. I can copy this to the right. Okay, so as you can see, it has copied the formula from here. So we are going to anchor this using F4. So, and also this one, anchor using hit enter before copying to the right using Control R. Alright, so with that we can have this total revenue multiplied by our projected percentage there, and then copy it to the right using Control R, and also reduce the percentage to 0 decimal places. General and administrative expenses, we can use the average once again. So this is equal to average anchor that, close your parentheses and hit enter, and then I can copy this to the right using Control R, and the percentage is going to be equal to this multiplied by my percentage, format this to 0 decimal places, and Control R, copy to the right. Alright, then for other operating expenses, we are going to do the same thing, but for here, let's pick the last year percentage here. So this is going to be equal to this, and then I can copy that to the right using Control R, and this should be equal to our revenue multiplied by the operating expense percentage. I'm going to reduce it to 0 decimal places and copy the formula to the right using Control R. Alright, so with this, we can be able to calculate our total other operating expenses by copying the formula from here. So I can copy the formula from there using Control R. Okay, so let's see if the formula is working properly. All right, so our formula works properly. And then with that, we can calculate our EBITDA, or our operating income, which is equal to our gross profit minus our total other operating expenses. So that is that. I can copy this to the right using Control R, and also bolding that using Control B. Also come to the top here and bolding my gross profit as well for the estimates as well there. All right, so our model is moving very quickly and nicely. And then we have our depreciation and amortization, which I said we are going to project using the PPA schedule under the supporting schedule section. So we are going to skip that for now. So that is that. And then we can also copy the EBIT as well as the EBITDA margins. Okay, so we can copy this and this to the right using Control R. For now, these figures are going to change once we insert depreciation and amortization figures. All right, so that is that. And then our interest income and interest expense is also going to be projected using the debt schedule under our supporting schedules and in a later video. So that's what we're going to do as well there. All right, now let's come to other income or expenses. Other income or expenses. Now, in order to properly model this line item, we would need a better understanding of what exactly it entails. All right, this other income here. All right, so a quick search of other income on our 10K reveals that it relates to equity warranty valuations, equity securities valuation, and adjustments, as well as foreign currency. All of these are dependent on market sentiments to a large extent. This makes it particularly difficult to project. All right, so other income, as you are seeing here, comprises a lot of other items or put together. So it is very difficult for us to make a ready projection of this item. So we need to do a bit of digging, and we have found out what they usually entails within the Amazon financial statement. All right, so these therefore calls for what? Various methods of estimating this particular line item. Now, in addition to the methods that we have identified earlier, we can also use the following to project other income as well. So the first one is what we call the repeat the cycle method. Repeat the cycle method, which is likely to be the most appropriate for this particular line item, since we are seeing that the figures are increasing or changing rapidly. So it will be very difficult for us to determine that this year is going to be negative or this year is going to be positive. So what do? We need to repeat the cycle so that whatever happens in the future, we are mitigating any risk of adverse movement in this particular figure. All right. And then a second method we can also use is to project out as a percentage of an income statement or balance sheet line item. But in this case, since the items are varied, all right, and they relate to different items spread across our financial statements, it will be difficult for us to link this particular line item to any line item within the income statement or our balance sheet. So for this method, we are going to, or for this case, we are going to use the repeat the cycle method. And how are we going to do that? All you have to do is to pick, we are going to assume that 2021 figure is going to be repeated for 2024, and that of 2022 is going to be repeated for 2025. That of 2023 is going to be repeated for 2026 as follows. So let's enter that. Let's enter that, and then I can copy this to the right using Control R. And what I'm going to do is this figure here actually is an outlier because it's a lot lower than the figure we are seeing here. So we are going to remove this outlier here and project only these two items. So I'm going to copy this and paste. Sorry. So what I'm going to do is to anchor this. So I'm going to anchor that using F4. I'm also going to anchor this using F4. All right, and then I can copy this and paste, and also copy this as well and paste for 2028. All right, so this is how we are projecting our other income to be going forward. All right, as I said, these are general assumptions we are making. As and when we gain more understanding of the business model of Amazon, then we can be able to tweak these assumptions as we move forward. This is what happens in real life, in practicality. All right. Okay, so that is that for other income. Now let's come to interest income and expense. So as I said earlier, all right, so let's copy this formula here also to the right using Control R. That is our total non-operating income or expense. Then with that, we can also copy this formula to the right, which is our EBT or earnings before tax using Control R right there. So these are our earnings before tax. Then we can also copy our EBT margin as well to the right using Control R. Now let's look at our taxes. Before then, let's look at the effective tax rates. All right. Now these are actually showing negatives here. Let's make it positive. So let's flip the sign here. Also come here and flip the sign for this, and also flip the sign for this. All right, by putting a negative behind the or before the numbers there. All right, so that is what we have there. Now let's look at, we know that in the US where Amazon is domiciled, the general tax rate is 35%. All right, but we see Amazon paying different income tax rates at different periods of the year. A zone is qualifying for tax rebates, some sort of. Okay, so again, we need to have a general understanding of the tax environment in which Amazon is operating for us to be able to make a realistic estimate here of the tax expenditure of Amazon. But for our purpose and to be able to save time, we are going to assume that, assuming that this year they have paid 19%, we are going to assume that, okay, our tax rate is going to hover around 25%. All right, 25%. So with that, I can copy this to the right using Control R. And so we can calculate our income tax provision. And that is going to be equal to our earnings before tax multiplied by the tax rate assumption. Reduce this, format it as an accounting figure with 0 decimal places, and copy this to the right using Control R. All right, so we have that. Now, since we are saying that the provisions are negative, let's put this as a negative, and then we can copy it to the right using Control R. Now, when you look at the income tax expenses here, these are quite huge. All right, but first of all, let's calculate our net income and see. So Control R right there, and this gives us our net income figures. That is okay. although the tax expenses, the provision for taxes looks quite huge. All right, they are quite huge, and so you can consider reducing this percentage to say 20% or 22%, sort of. So let's actually do that. Let's reduce this to 22% and copy that to the right. All right, so that is that for our tax expenses as well. Then let's come to equity method investment net of tax. So with this is also something that is very difficult to project. So we can do repeat the cycle method here. So we are going to have equals these three items here, which sorry. So what I'm going to do is to copy this, paste it here, and also paste it here, and then I can delete that. All right, so this is what we call repeat the cycle method. Now the 12 is also looking like an outlier because the negative is quite huge, the loss is quite huge here, but let's leave that for now. We can later come and adjust these items. So let's copy the net income or loss as reported to the right using Control R. All right, so let's see if our formula is working properly. That is working properly. All right, so that is that. And then we can also calculate our earnings per share here. Now for the earnings per share, we are going to assume that the last year earnings weighted average shares used in the computation of earnings is going to remain the same. So I'm going to copy this to the right using Control R. And then we can calculate our earnings per share, which I will copy the formula from here to the right so that we can obtain our earnings per share figures. All right, so this is how we can project our income statement, as simple as that. All right, so what we are left with now is our depreciation and amortization expense, which we are going to build in our PPE schedule in a jiffy or in our next video. We have interest income and expenses as well, these two items also there for us to complete. So these are the three items that are left for us to fully complete our income statement. All right, so thank you very much for your time, for sticking with me to the end of this video. I hope you understand what it means to actually calculate historical financial data, ratios from historical financial data, and also make income statement projections. All right, so in our next video, we are going to continue with our cash flow statement and also build our PPE schedule, which is part of our supporting schedules, to be able to complete our cash flow statement and also move on to the balance sheet. All right, and by the end, we'll be able to build a complete 3-statement model. Now, our focus is actually to forecast the performance of Amazon, and we are also going to value Amazon over this period 2024 through to 2028, and we are going to value them using the 3 common valuation methods: DCF model, COMS, which is comparable analysis, and also analysis. So we are going to use those 3 commonly used valuation methods to be able to value Amazon over this period. All right, so thank you for sticking with me. Please subscribe to the channel if you have not done so already, and also consider liking a video and share with others so they can also benefit. All right, so I'll see you in my next video.